Good morning. It's Friday, the 10th of July, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. Our top stories and themes. What signals are the markets really looking for? How India Inc.'s revenue grew 11% plus in the latest quarter and what drove it? How are manufacturers responding to extreme climate situations from heat waves to now heavy rainfall? And India to prepare for peak demand of 300 gigawatts of power next year from about 270 this year.
This is the Core Report with Govindraj Ethiraj.
So the key question in the markets right now is, what are they giving more prominence to? Is it the monsoons that appear to be doing better right now after a disappointing start, though that could change again? The war in West Asia, which looked like it was going to go back into a full-blown mode just 48 hours ago, but may have cooled off a little bit right now. And we're saying that because Brent crude futures were down 11 cents to about $77.91, so under $78, a day after they were looking like heading towards and crossing the $80 mark quite easily. Though traffic through the Strait of Hormuz has come to a near standstill on Thursday after the US struck Iran for a second straight day, as the truce looked increasingly shaky, according to Bloomberg, which added that observable movements largely occurred along an Iran-approved route nearer to the waterway's north, while the US-supported Omani corridor was quiet. This was based on ship trekking data. So what do analysts expect to happen? Well, on the monsoons, we can't say, but on US President Donald Trump, apparently you can lay down a few more bets on what he could do next, or more appropriately, not do. We'll have more on that in a moment, not on Trump, but on what the markets are expecting. But before that, the monsoons. The good news is that the southwest monsoon has covered the whole country on Thursday, 35 days after it touched Kerala. The last time it took that long was in 2021, when it took 40 days to cover the country. Now, looking ahead, the next fortnight is expected to see below average rainfall to the country's western and southern regions, potentially slowing the sowing of cotton, soya beans, and corn, according to weather officials who spoke to Reuters. According to them, the Madden-Julian Oscillation, or MJO, is unlikely to be favorable over the next fortnight, and the chances of any low-pressure system developing during this period are also low. As a result, the Weather Department, or the India Meteorological Department officials, told Reuters, Maharashtra, Karnataka, Telangana, Andhra Pradesh, and Kerala could receive below-average rainfall. And by the way, heavy rain during the first 8 days of July, something that many of us have experienced, particularly along the west coast, shrank the country's rainfall deficit to 15%. However, it could widen again in coming days as the monsoon takes a break, according to another Weather Department official. With all this as a backdrop, the Sensex rose about 238 points to close at 76,741, and the Nifty 50 was up 80 points to close at 23,962. The broader markets were up too, with the Nifty mid-cap and small-cap ending about 1.38 and 1.8% higher. India's consumer inflation has mostly crossed the Reserve Bank of India's medium-term target of 4% in June for the first time in 16 months, according to a Reuters poll, thanks to higher food and fuel prices, the war, and a weak monsoon. Consumer inflation measured by the annual change in the Consumer Price Index is expected to have risen to 4.3% for June from 3.93% in May, according to that poll, which spoke to 37 economists and was conducted between the 3rd and the 9th of July. So how has the first quarter been, which is the first quarter that just went by, for companies? Now, a report from Crystal Intelligence says that corporate revenue is estimated to have grown 11 to 11.5% in that first quarter ending June 30th, 2026, which is the fastest pace in 2 years, despite the supply disruptions and increase in input costs caused by the West Asia conflict. And that compares with a revenue growth of 9.6% in the preceding quarter, according to that report, which also says that while growing uncertainties around crude oil and gas, both prices and supply pushed up fuel, freight, packaging, and feedstock costs and tested corporate profitability, domestic demand actually held up reasonably well, helping companies in many sectors pass on the burden to end consumers. This analysis is based on more than 400 companies across 47 sectors and represents nearly half of India's listed market capitalization. On the other hand, profit margins did fall, or likely fell, by about 75 to 100 basis points as companies faced higher fuel, freight, and raw material costs. So the big change, of course, is that prices are doing more of the work as opposed to previous 2 years when revenue growth was powered more by volume. This time around, pricing contributed to revenue growth as opposed to volume, that is, in sectors like aluminum, steel, cement, airlines, fertilizers, and gems and jewelry. And airlines are a particularly good example because that's something that we've all felt. Revenue is estimated to have increased 18 to 20%, even though volume, that is, volume of passengers flying, fell by 3 to 5%, and fares had risen anywhere between 23 to 25%, thanks also to higher aviation turbine fuel costs. Among some of the major results just coming in, TCS has reported a net profit of about 13,000 crores, up 4.6% from the first quarter of 25-26. Revenue grew about 14%, and sequentially, the firm's revenue is up 2.2%. In constant currency terms, revenue was up 0.4%. So there is obviously a dollar or a rupee depreciation benefit here. Compared to Bloomberg estimates, the company's performance was a beat on revenue growth and a marginal miss on profit. And revenue was expected at about 71,800 crores and net profit of 13,394 crores. Among sectors that are likely to continue to do well this year, amongst many others, of course, power is one of them, something that we've been talking about a lot on the core report. India will need to prepare for peak power demand of about 300 gigawatts next year, India's power minister said on Wednesday evening, while urging faster development of domestic clean energy supply chains. India has already met a record peak demand of about 271 gigawatts and could rise to between 276 to 280 gigawatts this year before approaching 300 gigawatts next year, the power minister said at the India Energy Storage Week in a report on Reuters. You can also track how India's power consumption is moving on a real-time basis by going to cleanpower.thecore.in. That's our website, of course. That's thecore.in. And the section is cleanpower.thecore.in. So you could actually see how much contribution each category of power is making. And particularly what I found interesting is how in the daytime, clean power is contributing to almost 50% of total power consumption. And as the evening sets in, that number keeps coming down as conventional power generation goes up and solar power, for instance, backs down. And gold prices, which we've not touched for a while, are still soft relatively. Of course, spot gold is about $4,068 per ounce, and it fell slightly on Thursday after dropping to its lowest level since July 1st on Wednesday. Analysts told Reuters that the catalyst that is supporting this trend, that is to the downside for gold, is a repricing of the second interest rate hike by the Federal Reserve to come in as early as Q1 next year. Elsewhere, after a decade of negotiations, Australia has agreed to sell uranium to India for power generation in a deal being termed as landmark and signed between the two nations during a visit to Melbourne by India's Prime Minister Narendra Modi. India will purchase uranium for exclusively peaceful purposes, the government said in a statement on Thursday. And the statement, of course, did not provide details on how much uranium oxide or yellow cake India would purchase or over what time frame. To return to markets, so what are the underlying strengths or weaknesses which could determine where it could go in coming days? I reached out to G. Chokkalingam, founder of Equinomics Research, and I began by asking him how he was seeing the underlying strengths or weaknesses that were holding up the market and that could determine where it could go in coming weeks and months.
So, first of all, I think the market has recognized a tremendous improvement on the rainfall. I have not seen this kind of volatility in the rainfall also in the last 20-30 years. At the end of June, the cumulative rainfall deficit was 42%. It will be surprising as we are speaking now, the cumulative rainfall deficit has come down to just 15% in a matter of 8-9 days. And number of subdivisions receiving normal or excess rainfall is now 74%. It was a reverse. In June, 2/3 of the subdivisions failed to get normal rainfall. Now, 3/4 of the subdivisions have got a normal to excess rainfall. So this is a remarkable change, and this is addressing the concern on inflation, all that, So that is one. Second, market reacted to Trump, the statement and attack in a big way yesterday. But I would attribute not everything to Mr. Trump's statement, because the small cap index recovered at 25% in 3 months. A lot of small caps suddenly rose 20 to 50%. The profit booking was waiting to happen. So his statement made some nervousness, and people used this to book the profits. So that is why yesterday Sensex and Nifty fell more than 2%. So definitely it is not exclusively for Trump's statement. I can say this confidently because he is known for reversing his statements frequently. Either you take a tariff war or you take Iran war. So the market doesn't believe that he is going to stick to his words and the war is going to last for long. So that is why the market was quite steady today also. And it is going to be steady. I am pretty confident the world cannot afford to have a war. All the 35 countries which applied pressures last time for stopping the war, they will be active in case the war continues. So other strong points for the market, the valuations have come down below 21 PE, trading PE, 5-year high is around 24. Oil price has crashed, 40% it crashed. Even after this renewed attack, oil price is still down 35% from post-Iran war peak price. And gold price also down more than 20%. So these two will definitely strengthen your external balance. And that is a key for attracting back FEI investments. And FEIs also, they moderated their selling in the recent days. And then apart from these, what are the strengths? The global market has seen, the boom and bust in technology stocks starting from 2000 .com bubble. So now there is a fear on AI, whether this is also going to be a bubble. Of course, I understand the fact that AI theme has got a lot of potential for growth and profit, but a lot of people accept one thing in common, that though the AI is not like a 2000 .com bubble, it has a credible, prospects for growth and revenue profits. But everybody assume that or accept that in the long term only the current valuation can be justified by the earnings. Hardly any sizable number of people are expecting current valuation to be justified by immediate short-term or medium-term earning from these companies. So that is going to keep giving a lot of uncertainty and fear for the investors investing in these stocks. That's why we are seeing periodic booking profit and stocks falling. And that volatility will continue. That will be a strengthening point for Indian market because it offers you defensive stock, domestic demand driven by diversified sectors, all that. Lastly, the DIAs and retail investors have started dominating the domestic market. So DIAs have exceeded FII. Now we saw in terms of inflows also mutual funds exceeding FII. And even now 6 to 8 lakh new investors are pouring in. So outlook looks good. The only three risk factors are, by any chance the IPO boom again gets renewed and there is a massive number of issues, then that can dry up the liquidity in the secondary market. By any chance I am wrong on my assumption of Trump not opting for a long-lasting war, really the war lasts for long, then the oil price again will zoom. These are the two possible risk factors. Otherwise, we are positioned for further significant recovery in the short term.
So in the last 2 days, we've also seen oil prices go up, Choka, and to some extent, the markets do track that. I mean, when oil prices went from 72 to $78 per barrel, the stock prices also fallen. That's been a consistent pattern in the past. So you're saying that we are not that much affected by oil price movements now, like before?
No, it is still a very key point because it's still connected significantly with the forex reserves, imported inflation, and therefore trade balance, and finally on the rupee exchange rate. It's a backbone of India's external economic strength or weakness. It will take another 10 years for reducing the dependence on imported oil because now renewable energy is 19% of the total energy. So once that grows to 40-50%, then definitely we will have a credible improvement and the oil will not dictate our economy and market. I mean, the bubble in the oil price. But now it is important. But the point I'm making is that post-Iran war, the peak price of Brent oil was 118. So yes, it is very sensitive to what is happening in Iran. It has gone up also in 2 days. But still, it is down by about 35% from that $118 per barrel, the peak we saw post-Iran war, which is a really comforting factor. And also, OPEC Plus has decided to keep increasing the oil supply. So as I said, again, the pressure will build up to, tone down the attacks by both parties. And again, the oil will correct. But once the ceasefire lasts for long, I am putting it on record that oil price can fall to even $50 per barrel Brent oil because world over the demand is going down and the supply is increasing. And oil import intensity in the economic growth is also coming down worldwide. And renewable energy is taking off in almost all the major economies. So we will have a very good time. India will be the maximum beneficiary.
Right. And what's your sense on Q1 results, which everyone is watching quite keenly?
Yeah, it's going to be a little disappointing as compared to Q4. So the profit growth can be overall anywhere 5 to 8% only year on year because of these disruptions caused by Iran war in June quarter. But definitely post that we saw oil cracking, even the metal prices coming down. So Q2 will be a better quarter in terms of earning growth. So therefore, market will not get punished for the single-digit profit growth because the expectations for Q2, Q3 would be too good. And also, let us not forget that bond yield slowly moderated. So there is no scope for rate hike. In fact, monsoon, if IMD goes wrong, monsoon performance becomes normal, then there is a chance of even interest rate falling. So all this would augur well for next 2 quarters.
Got it. Chokka, thank you so much for joining me.
Thank you.
We may be agonizing over the delayed monsoons and now, of course, the impact of very heavy rains and loss of lives and livelihoods in the last 10 days or so. But recall that just before that, we were battling heat waves across the country, posing considerable public health challenges, particularly at workplaces. All of which leads to or has led to shifts in the way companies are organizing their workforces and their workforce timings or their shifts. So how are companies with large manufacturing footprints responding to this rapidly evolving situation? I spoke with Tejashree Joshi, Head of Environmental Sustainability at Godrej Enterprises Group on this theme. Now, Godrej Enterprises includes Godrej and Boyce, which represents a range of well-known businesses, including traditional furniture, appliances, and locks to aerospace and real estate. I began by asking Tejashree how groups like hers were responding to the evolving challenges of climate and weather and what was at stake.
I think it impacts enterprises in a big way, not only just, the direct operations, but more and more we are becoming conscious about its impact on our supply chain and the entire value chain of the business. So if you ask me frankly, how are enterprises currently now responding to these kind of climate events? I think climate change has become to a center of enterprise risk management. So it's not just sustainability or something that you do good, but rather it is now hinging around how do you minimize the impact of the business continuity itself because of climate events. And therefore, ERM is essentially now addressing climate change as a big risk, not only from climate point of view, but also from social and business continuity point of view. Disruptions are real. We see that in operations. And let me first address the heat issue. And we've seen extreme heats, especially when it comes to manufacturing and construction sectors, which are a lot more physical activity per se, therefore impacting the real on-ground work. This starts with beginning to think about this aspect all throughout the year as we prepare for manufacturing. And there are multiple levels at which this is happening. It's looking at the work timings. How do the shifts get staggered because of the extreme heat and, those very peak hot hours of the day, giving rest to the workmen during that particular periods of, say, between 1 o'clock to 4 o'clock or 3 o'clock in that sense. But at the same time, because we cannot actually stop operations, staggering the times and giving rest is becoming important. And it's not just one, it is intermediate multiple breaks which are required to address the fatigue that comes in the workforce to maintain productivity. That's one part. The other aspect is about, how is the physical environment in which the workmen are actually performing their duties addressing these, say, air changes, or how do we keep the inside of a factory cool? At the same time, driving our agenda on energy efficiency. We can't lose the focus of that. So there are passive architectural interventions which are happening in the factories where air changes, natural air changes are happening. But while they happen, how does the air get cooled so that, the working environment inside the factory is more bearable and doesn't impact the workmen per se, because even the processes generate heat, the processes generate fatigue. So air changes are extremely important. At the same time, cooling that air is becoming more important. And how do passive architecture basically play a larger role in that, along with, mechanized and active ventilation support that we are providing. So these are infrastructure level preparedness that industries are now looking at. There's something called as physical climate risk assessments. There are frameworks, and these help companies or enterprises to evaluate their climate related risk to their physical infrastructure and assets and address them by planning budgets, by putting in annual plans in terms of how these are to be addressed, and prepare for such events even before they occur. Because more and more we are seeing that this is happening more frequently. So it's not a one-off event. It's almost like kind of becoming more patternized in going ahead, that the climate is not going to be as regular as it was. And therefore, preparing the whole physical infrastructure or assets to get to that within the factory premise is one important aspect. When you use these frameworks, you get those indicators where these investments are necessary and how they play out in sustaining the business and the workforce forward. And it can be for heat, it can be for, extreme flood events or drought, all of those climate risks.
And I'll come to that. So you talked about introducing more breaks or intermediate breaks during a shift, for example, which is not the same as before. How do you arrive at, let's say, the most optimum number of breaks or the time for those breaks and at what time of the day and so on? Because I'm assuming you're moving from a classic, tea, lunch, dinner phase to something different.
As you rightly said, it cannot be the same that it was as usual. Of course, these hydration replenishment breaks are essential. But it is more so in terms of what is the heat and what is the delta increase in heat that we are seeing during the day times, particularly the peak hours of the day, and addressing those hours very critically in terms of resting the people. Especially if you go for a construction sector, I mean, people are really working outdoors and they are direct exposure to sunlight. They need rest. They need to be rested, or they need to be allocated work which are indoors and which are less physically intensive. As you plan the work front in a factory or on a construction site, there are different kinds of works where different levels of intensity of physical activity are essential. So that planning needs also to be tweaked during these particular months, that how do you keep the workers engaged in productive work, but with a lesser stress in terms of physical stress by heat and activity, but carrying on those works which would otherwise, be done in some other time. In a normal routine could be done at any particular time. That tweaking of activity when you're planning the whole work on project sites, construction sites, or within the industry, within the factories, that become essential. Now, there's a difference in when you see inside a manufacturing plant and when you actually see on a construction site, which is outside, Inside a manufacturing, it's much more controlled environment. Air changes can be controlled by mechanical means. They're easily available. Cooling breaks are present. Hydration points are present where people can actually access and address these issues. It becomes even more critical when you're talking about a construction site, which is outdoors. In that scenario, in fact, looking at more deeply in terms of not only just hydration, but providing very simple things like a glucose or, during the hydration as well. So that doesn't impact in terms of dehydration for the workmen. It may seem to be small interventions, but they become very critical when you actually look at the stress that it creates if it is not done for people, especially when they are outdoors. So we very carefully take care of that. Our construction sites address these breaks, make available these hydration points very close to the working places where the physical movement just for water shouldn't be that exhaustive, that we'll try and avoid that. That's how we try and address that. But it's all planned. It has to be planned before the event starts occurring. And accordingly, the work schedules also are tweaked.
Right. And what you're seeing today or right now in many parts of India, now slowly across India, is obviously extreme rains and the impact of that. And you talked about also the supply chain impact because of all of this. So how do you now then change, or rather, how different is the strategy for this kind of extreme weather conditions?
Basically assessing the risk across the supply chain. So when you're looking at a supply chain, it's not just, whether the supplier is capable of supplying to you the quality and the volumes that you expect, but also where are their physical factories located, from where is the raw material or the supply parts are really going to come. As I was mentioning about physical climate risk assessment for our own factories, we also extended to a supply chain continuity in terms of what are the high risk zones from where materials are getting sourced. And then there are multiple strategies by which you address. These kind of extreme events are happening and we see a pattern. There are things that you preempt and do in terms of not only assessing their capability of addressing the disruptions, but also look at, de-risking if there is a very high critical supply chain, which is falling into very quite vulnerable climate zone. So spreading the risk is extremely important nowadays if you want to look at a business continuity. And not only in terms of capability, but it also in terms of physical geographies, so that the disruptions are minimized. Of course, I would not say that they are absolutely not there. Very extreme events, I mean, we are not able to either predict it or address it, but minimal impact is what organizations are aiming. De-risking in terms of spreading it, as I mentioned. Also sensitizing the supply chain in terms of this risk. Because many times, the suppliers are MSMEs, small suppliers. They do not have the wherewithal to even do this assessment. So if we are identifying certain risks that we have with a critical supplier, we help them address that or sensitize that in terms of that this can be a potential disruption. For the large organization, of course, the supply chain, but for that company itself, it's a big impact, even a larger impact, because their whole operations come to a halt. In terms of, inventory stock ups, in terms of managing that, making that availability sustained for a certain period of time if disruptions are to happen. plus even the whole logistics of produced goods into that impact. So these analyses are done for the geographies which are to be served, the impact levels, how much of inventory stock up needs to be done for addressing certain peak times of, say, a week or a month of whatever is estimated basis the risk assessment. These are smaller actions. But largely, we have to look at it with an end-to-end risk perspective, right from, the raw material sourcing to the dispatch of produced goods to our consumers' end. All those touch points where this risk is pertinent or where the risk levels are higher as we estimate, those are to be addressed on a more systemic and a framework basis. It's not just, reactive actions. But what we do is basically start planning for these events at those touch points. Of course, industry is gearing up. Of course, no plan is foolproof. But I think certainly we are learning more to address these risks in terms of adaptations.
Tejashree, thank you so much for joining me.
Thank you so much.
A new report by Kotak Mutual Fund says India's macro outlook has improved despite geopolitical shocks. It argues that following the West Asia ceasefire, India's 26-27 macro outlook has improved, expects real GDP growth of about 6.6%, inflation to moderate, and the current account deficit to remain manageable, though El Nino remains the biggest domestic risk. However, it does say or sees evidence that private corporate capital expenditure has started rising, which should support nominal GDP growth over coming years. It also says, therefore, that the investment cycle is broadening beyond government infrastructure spending. It also believes that the recent Reserve Bank measures, which other analysts have also been talking about, to ease foreign investment rules and incentivize foreign currency deposits could attract about $50 to $75 billion of inflows. It also says, despite softer PMI readings, manufacturing is showing resilience backed by electronics, defense, localization, smartphones, and core industrial sectors. And it estimates that the proposed agreements for free trade with the European Union, trade agreement with the United States, and another free trade agreement with the United Kingdom could add about $53 billion to annual exports over the next few years. So what does this mean for valuations and markets? The Nifty 50 is trading close to its long-term average valuation. Mid-caps and small caps continue to trade at premiums to history, and therefore future returns are likely to come from stock selection rather than broad market expansion, according to Kotak Mutual Fund. And of course, if macro conditions improve and capital inflows materialize, India has scope for significant foreign reallocation. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.